The next member we're going to recognize would be Mr. Stivers from Ohio. We'll recognize him for 5 minutes.
Thank you, Mr. Chairman, and I have some questions, most for Ms. Galante. You said earlier in an answer to Representative Capito that you didn't think FHA was broke, but I'm really worried about the exposure to the taxpayers, and I do have some questions, many of which are answered in your testimony, and the first couple are pretty simple yes or no questions. FHA is congressionally mandated to maintain a 2% capital reserve ratio in the mortgage insurance fund. That's correct. Is that true or not?
That's correct.
And in 2010, that capital ratio was at half of 1%. At the end of last year, there was a GAO report that found it at about 0.24%, or about a quarter of 1%. Is that correct?
It was actually the independent actuary.
Oh, I'm sorry, the independent. So, okay. But is that about where you would say it is today, at about a quarter of 1%? 0.240, I think, is what I saw.
That's correct. Again, that actuary is done once a year and is based on a variety of economic inputs, including how much insurance in force we have. So it's not possible, like on a monthly basis, to...
I understand. So if that's not broke, I guess, is it not broke until it gets to zero? Because we lost half the value of the reserve fund last year, and if we lose at the same rate this year, it will be at zero or below. And I understand there's the settlement agreement with the servicers, and you're finally raising your insurance rates. But what does constitute broke if that's not broke?
So again, to be clear, the capital reserve account is, and the 2% is for, quote, excess reserves beyond what the actuary predicts we need for 30 years worth of losses. So we do have $30-some billion in our account to pay for losses. So I'm not saying that it's a good place to be on the on the edge.
But it is congressionally mandated. I mean, it is the law of the land that you have to have 2%. And I guess it goes back to my next question is, and maybe I'm wrong about this, but I believe in 2009, and I wasn't here in 2009, Congress gave FHA the authority to raise their rates. You're finally going to raise your rates by 10 basis points this year on basic loans and an extra on jumbo loans. But the way my math works, you're actually authorized to raise your rates by about 30 basis points on all loans this year. And if your financial condition is where it is and you're not meeting the 2% law that you're required to meet, why are you not raising your rates by the maximum allowed under law?
Yes, thank you for the question. Let me just say, it was in 2009 where we got additional flexibility to raise our premiums. We did not have it before then. We have more than doubled our rate since then. What's in the latest budget is just the additional amounts, but
you haven't raised it the maximum amount every time you can.
We have not, and let me just explain why we have not, because there is an important tenet here, which is we do want to raise the premiums as one place to go in terms of ensuring the health of the fund, but we are raising premiums on new borrowers to essentially deal with problems of the past, and at some point you get into a very difficult situation in terms of the impact of that on borrowers and on this market that is in a very fragile recovery. So in our judgment, we are doing everything we can by raising premiums, by going after lenders and ensuring that we're recovering dollars that way, by ensuring that our REO process is recovering what we should be recovering through that. And so we are using multiple measures, not just premium increases, to ensure that we will get the fund back to the capital reserve of 2%.
Right. And, there's sort of three parts of the mortgage market. There's Fannie and Freddie, there's the private market, and there's FHA. And Fannie and Freddie have raised their G fees already, and you've not actually even kept up with the raises in the G fees at Fannie and Freddie. So doesn't that actually just drive volume to FHA and make FHA potentially even more vulnerable over time because you're not raising your rates to an actuarially sound point?
So again, I would, I guess, need to differ somewhat on whether what we're doing is actuarially sound. We believe that, again.
Can private mortgage insurance match your rates?
Pardon me?
Can private mortgage insurance match your rates?
Well, I don't believe they are doing so, but.
Do you think that are you saying that they are doing something that's more than actuarially sound then? I mean, that's what I would use that as certainly a measure to say what's actuarially sound is what happens in the private marketplace. And, government has a really bad history of mispricing risk. So I know my time's expired, but I would ask you to take a serious look at that. Thank you, Mr. Chairman. Sorry for going over.
Thank you, Mr. Stivers.